Hello, I'm Steve Bryce and I'm Standard Chartered's Chief Investment Officer here in Singapore. Over the next few minutes, I'm going to be chatting with Audrey Goh, who's our asset allocation head, and talk about our macro strategy for the second half of the year. When we released our 2023 outlook, we argued this year would be much better than 2022. Not difficult, of course, given the dramatic sell-off we saw in both equities and bonds last year. However, even we were not looking for the strong rebound we've seen this year, with our diversified growth allocation up around 7% year to date. We've just released our second half outlook, Keep Calm and Carry On. Audrey, we're all in this boat together. We still face significant uncertainties, including the timing or magnitude of a recession and the outlook for US-China relations. What do you mean when you say keep calm and carry on?
Well, at a high level, it goes back to two of our key investment principles: stay invested and invest with discipline. It is so easy to get knocked off track by either promises of quick wins or heightened fears of an uncertain outlook.
Okay, so what does the C, A, L, and M stand for in calm?
C is for capitalize on market opportunities. In the second half of the year, we expect to be assaulted by two extreme narratives. First, the no lending scenario, in which the avoidance of a US recession argues for chasing equities as well as risky bonds higher. The second is that we are perhaps on the cusp of a deep recession, and that risky assets are maybe not worth holding. And we believe that the best portfolio strategy lies somewhere in the middle. So against that backdrop, we prefer high-quality bonds relative to cash. Cash rates are close to peaking. Hence, investors are better off locking in longer-term rates now rather than rolling their cash at lower yields in the quarter ahead. In any cycle, Fed fund rates, Fed policy rates will go lower as growth slows. This will push yields lower, benefiting bond prices. So quality bonds will not only be a source of income for investors, but also offers potential for capital gains in an economic downturn, which is why we advocate adding to quality bonds over cash. And meanwhile, we have moved equities up to a core allocation. In our view, an overweight view on developed market investment-grade government bonds and a core allocation to global equities will allow us to balance the strong equity market momentum that we see today against delayed but still very real risk of US recession.
Okay, so that's C. I know after years of seeing investors sell at exactly the wrong moment, that A is a very passionate topic for you. So what does A stand for?
A is for allocate broadly. So in an environment of strongly competing narrative, we expect diversification to trump a concentrated approach. Investors can allocate to their foundation allocation and complement that with gold, liquid alternatives, or private assets, as these asset classes can act as diversifier to portfolios. Robust central bank demand is also likely to place a floor under gold prices, and gold generally benefits during risk-off events.
Okay, what about L?
Well, L is lean towards Asia. We expect Asian equities to outperform global equities. China's economic opening has so far failed to translate to equity market gains as US-China tensions have kept investors away this year. So domestic policy is likely to turn increasingly stimulative as policymakers become concerned about deflationary headwinds. Now, in the case of Indian equities, the structural outlook is attractive. As valuation eases from their high, this should create better value for long-term investors. We also maintain our overweight to Japanese equities. The outlook is attractive, nominal GDP growth is accelerating, with inflation finally peaking up. We are also seeing increased share buyback and dividends, which is supportive of the positive outlook on Japan. And finally, within bonds, we like Asia US dollar bonds for their credit quality and high current yield relative to developed market peers, as well as history. This means that the asset class should benefit from eventually lower US bond yields and its attractive current yield on offer.
Okay, so we're leaning towards Asia, but what does M stand for?
M is for managed volatility. Investors should be prepared for episodes of heightened volatility, both on the upside and downside. So opportunistic idea can be an additional source of returns in this context. We would use opportunistic allocation in three ways in the second half of the year. First, adopt a barbell sectoral strategies in US and Europe area with the focus on both cyclical as well as defensive sectors, which will help balance both upside as well as downside risk in developed markets. Over in China, the focus is primarily in the consumer sectors, which is seeing support from earnings as well as policy perspective. We would look for cross-currency opportunities given our view of a range-bound US dollar over the next 1 to 3 months, and this would give rise to range trading opportunities in select cross-currency pairs. And then last but not least, we would also look for opportunities to sell volatility on any spikes. The level of volatility today remains at the lower end of recent ranges and likely will have room to move higher. So investors can take advantage of any short-lived spikes in volatility to generate returns.
Okay, so this is really interesting, but how do you balance all of this out?
So balance is a great way to think about it, right? It is important to factor the risk of upside in risk assets into your investments, but still not get too wholeheartedly finding comfort in the upside narratives. The forward-looking indicators that we monitor still suggest a recession is coming, but it might be later than previously thought. Therefore, I guess it comes back to ensuring your investments matches your risk tolerance and you are adequately diversified to dampen the swings in your portfolio valuations as well as your mood.
Thank you for your insights, Audrey. A real pleasure talking to you as always.
Pleasure to be with you, Steve.
That's a brief overview of our outlook for the second half of 2023. To find out more, please look out for the 3 other videos we've produced in this series, which explain our asset class views on bonds, equities, and currencies. Meanwhile, if you'd like to know more about either our SC Wealth Select framework or how to make what we've discussed today real for you as an investor, please make an appointment with your Standard Chartered Relationship Manager. Thank you for watching this short video. To find out more, you can download our full second half report in the link below. In the meantime, Audrey and I wish you a fantastic second half of the year.